Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that today's meeting is also open to the public through a live webcast. For anyone watching online, if you would like to view the closed captioning of this meeting, please click on the CC icon located in the lower left corner of the WebEx window. You may also change the layout to one of your choosing by clicking on the layout option on the top right side of the page. Now, turning to our agenda, the first and only item of business today is a board briefing on the Share Insurance Fund quarterly report. Staff presenting, Eugene Sheed, NCUA's Chief Financial Officer. Good morning, Eugene. It's good to see you. You may begin whenever you're ready.
Good morning, Chairman Harper,
Good morning.
Vice Chairman Hutman, and Board Member Hood. I'm Eugene Sheed, and I'm here to present the 2022 third quarter statistics for the Share Insurance Fund. Before I begin my quarterly update, I will note that the NCUA's Office of the Inspector General, through their contract they monitor with KPMG, an independent certified public accounting firm, performed an audit of the NCUA's schedule of contributed capital as of September 30th, 2022, as part of the government-wide financial statement audit. KPMG found the schedule presents fairly, in all material respects, the contributed capital of the National Credit Union Administration as of September 30th, 2022, in conformity with U.S. generally accepted accounting principles. There were no significant deficiencies related to internal controls for the schedule that were considered to be material weaknesses, and there were no instances of non-compliance with other matters that are required to be reported under government auditing standards or OMB Bulletin 21-04. Slide 2. This table shows the Share Insurance Fund's revenues and expenses for the third quarter of 2022. For the quarter that ended September 30th, 2022, the fund recorded a net income of $26.2 million. Total income of $73.7 million primarily consists of investment income from Treasury securities at $73.6 million. Other expenses were $53.1 million for the quarter. The provision for insurance loss reserve expense increased by $16 million during the quarter. I will discuss that further on slide 4. The asset management estate loss reduction for natural person credit unions and corporate credit unions was $7 million and $14.7 million respectively, due to favorable changes in future cash flows of assets held by certain asset management estates. Slide 3. This table shows the Share Insurance Fund's balance sheet as of September 30th, 2022, compared to the previous quarter. As of September 30th, total assets are valued at $20.2 billion, of which 96% are funds held with the U.S. Treasury in cash, overnight investments, and long-term Treasury notes. Total assets decreased by $43.4 million, primarily due to an unrealized loss on the Treasury investments, offset by capital deposit adjustments for credit unions with assets over $50 million. The net receivable from the asset management estates is $81.4 million. The receivable from the natural person credit union asset management estates increased by $0.5 million due to an increase in AME claim payments and the change in expected cash collections, partially offset by AME receipts and recoveries. The receivable from the corporate credit union asset management estates decreased by $0.8 million, primarily due to cash collections and recoveries, partially offset by claim payments and the change in expected cash collections. Accrued interest and other assets are $130.1 million, which increased by $7.5 million, or 6% from the prior quarter, mainly due to an increase in Treasury interest receivable. Total liabilities are $218.3 million, or 1% of total assets. Accounts payable and other liabilities of $35.1 million primarily consists of credit union refunds on capital deposits. The fund's net position is comprised of the cumulative results of operations and capitalization deposits. Capitalization deposits consists of 1% of each federal credit union's total insured shares. Net capital deposit activity increased by $536 million during the quarter. Cumulative results of operations decreased by $625.9 million during the quarter due to an unrealized loss on investments of $652.1 million, offset by the $26.2 million in net income for the quarter. And as a reminder, unrealized investment gains and losses do not factor into the calculation of the equity ratio. Slide 4. The CIF records an insurance program liability comprised of general and specific reserves to cover losses resulting from insured credit union failures. Each quarter, the CIF assesses the reserve needs for credit union failures to make a reasonable estimate of losses. During the third quarter, the reserve expense increased by $16 million, primarily due to an increase in the general reserves. The reserves totaled $183.2 million at quarter end, and that was comprised of $11.3 million for specific reserves and $171.9 million for general reserves. Slide 5. Through the third quarter of 2022, 4 credit union failures incurred loss to the fund. There were 2 involuntary liquidations with purchase and assumption agreements and 2 assisted mergers. The cost of the failures for 2022 is $7 million. Fraud was a contributing factor in 3 of the 4 failures. Slide 6. As of September 30th, 2022, the Share Insurance Fund had $20.7 billion at par value invested in Treasury securities with maturities out to February 2030. The weighted average life of securities held by the fund is 3.6 years. The weighted average yield of securities held by the fund increased 8 basis points from the prior quarter to 1.42%. The lower bar chart shows the cumulative picture of how much of the portfolio will mature over time. About 69% of the portfolio will mature over the next 5 years. During the third quarter of 2022, 8 Treasury notes matured for $600 million. These securities had yields ranging from 0.12% to 2.12%. Slide 7. Turning to the equity ratio chart, the current equity ratio was calculated as of June 30th, 2022. Per policy, the equity ratio is updated on a semi-annual basis. The equity ratio as of June 30th, 2022 was 1.26%, which remained the same from December 2021 and was calculated using an insured share base of $1.69 trillion on June 30th, 2022. The blue line running across the chart represents the normal operating level, which is set at 1.33% in December 2021. The lower line shows the statutory limit of 1.20%. The Federal Credit Union Act requires the NCUA to adopt a restoration plan within 90 days when the equity ratio is either projected to decline below 1.20% within 6 months or if it falls below 1.20%. As a reminder, the projected equity ratio is 1.30% for December 2022, as I reported last quarter. Slide 8. The third quarter CAMEL data presented on the following 3 slides is current as of September 30th, 2022. This slide shows the distribution of insured shares by CAMEL's code from 2017 through 2022. The area graph at the upper portion of the slide, the upper portion of that graph is the percentage of total credit union insured shares that are CAMEL's coded 4 or 5. The middle section represents the percentage that is CAMEL's coded 3, and the lower section represents the percentage of credit union insured shares that are Camels Code 1 and 2 credit unions. The table underneath the graph displays the total number of credit unions by their respective Camel codes. During the quarter, the percentage of insured shares at credit unions Camels coded 1 and 2 slightly decreased. The percentage of insured shares at credit unions Camel codes 3 increased slightly, while the percentage of insured shares at credit unions Camels coded 4 and 5 remain the same. As depicted in the bottom table, the number of credit unions as of September 30th, 2022 was 4,827, a decrease of 19 credit unions from the prior quarter. Slide 9. This slide compares credit unions Camels code by asset size. Camels 4 and 5 credit unions are shown on the left-hand side, whereas Camel Code 3 are displayed on the right-hand side of the graphic. Looking at the 120 total credit unions that are Camels coded 4 or 5 by asset size, most of these credit unions continue to have assets under of $100 million or less. During this quarter, there was no change in the number of Camels coded 4 or 5 credit unions with assets from $100 million to $500 million. Additionally, as was the case in the prior quarter, there are no credit unions Camels coded 4 or 5 with assets greater than $500 million. During the quarter, both assets and insured shares for credit unions Camel coded 4 or 5 increased. Assets increased from $3.7 billion to $3.8 billion, and insured shares increased from $3.5 billion to $3.6 billion. Turning to the 768 credit unions Camel coded 3, most of these credit unions continue to have assets that are less than $500 million. During the quarter, there was no change in the number of Camels coded 3 credit unions with assets that range from $500 million to $1 billion. Those credit unions with assets greater than $1 billion increased from 4 to 6. For credit unions coded Camel 3, insured shares increased from $39.3 billion to $42.3 billion, and assets increased from $44.5 billion to $47.9 billion. Slide 10. This slide shows the distribution of assets by Camels code from December 2007 through September 2022. As in slide 8, the upper portion of the chart represents the credit unions that are Camel coded 4 or 5. The middle section represents the percentage that are Camel coded 3, and the lower section is the percentage of credit unions Camel coded 1 and 2. During the quarter, the distribution of assets for credit unions Camels coded 1 and 2 decreased from 97.7% to 97.6%, and Camel Code 3 increased from 2.1% to 2.2%, and credit unions Camel coded 4 or 5 remained at 0.2%. Slide 11. This concludes my presentation.
Update on the performance of the National Credit Union Share Insurance Fund during the third quarter of this year. And thank you to all of your team for their hard work in preparing today's briefing. Before turning to the state of the Share Insurance Fund, I would also like to thank and recognize your team for its good work on receiving an unmodified or clean opinion in the Share Insurance Fund's fiscal year-end audit as part of the government-wide financial statements. This success demonstrates the NCUA's ongoing commitment to sound financial management and the careful stewardship of the Share Insurance Fund's resources. Thank you, everyone, for a job well done. Overall, the Share Insurance Fund continues to perform well. The changes in the interest rate environment during the third quarter increased the income and earnings of the Share Insurance Fund. That is one positive benefit of rising interest rates. In recent years, the low interest rate environment has reduced the Share Insurance Fund's ability to generate revenue to offset expenses and the system's growth in insured shares. Eugene, that brings me to my first question. On slide 2, if we could pull it up, you reported that the investment income was $73.6 million in the third quarter of 2022. That figure is roughly $5 million higher than last quarter and approximately $14 million higher than 1 year ago. Is this increase attributable attributable to growing interest income overall, or is it explained by a reduction in expenses related to the liquidations on the remaining corporate assets?
Okay, thank you for that question. The rise that we see on slide 2 of the investment income and the changes that you noted, the comparisons from the prior periods, would be attributable to an increase in the interest rates. But just to go a little bit further,
Yeah.
Over the past several periods, I would add that the fund's overall net income has also been helped by the corporate asset management estate loss expense reduction and losses and liquidations in operating expenses, which also impact the bottom line for the fund, have remained pretty constant over the past several quarters.
Okay.
Thank you.
Thank you. Eugene, it helps stakeholders to understand how your explanation helps stakeholders to understand how changes in the interest rates contribute to the Share Insurance Fund's financial health and the equities ratio strength. Unfortunately, the Share Insurance Fund report for this quarter also shows another side of rising interest rates, with an increase in the number of credit unions with a composite CAMELS code 3, 4, or 5 rating. Additionally, several credit unions have experienced liquidity issues recently, including some with more than $1 billion in assets. And with ongoing inflationary pressures and continued interest rate increases likely, the potential for headwinds slowing the economy and increasing stress on households and financial institutions continues to grow. As such, the NCUA and the Share Insurance Fund must remain ready to act. That brings me to my next question. If we could flip to slide 4 on your presentation, where you show that there was an increase in the Share Insurance Fund's reserve balance. Would you explain why there was an increase and the analysis used for making that increase? And how does the current reserve balance of $183.2 million compare to the periods before the pandemic?
Okay. There are two primary components to the reserve methodology, the specific and the general reserves. Both of those increased during the quarter, so both of them helped to contribute to that increase. When the NCUA has reasonable information regarding the timing and amount of assistance required for a failing credit union, then specific reserves are established. And about a third of the change, or roughly $5 million, that we saw from the previous quarter was due to a change in the specific reserves for such a loss. The vast majority of the reserves as of September 30th, about $172 million of the $183 million that's on slide 4, was attributable to the general reserves. Okay. To calculate the general reserves, the NCUA uses an econometric reserve model. That model uses external economic predictors and individual credit union specific data to predict the probability of failure and estimated loss levels. So to your question about sort of comparisons to prior periods, so since the onset of the pandemic, the reserves, the general reserves, have generally fluctuated up and down within a pretty tight range of about $20 million. But looking back over the 5 years prior, to get at your pre-COVID question, the range was much wider than what we've seen. The current general reserve sits in about the middle of that range if you were to look back over that prior 5-year pre-COVID period.
I appreciate that insight. Let's turn now to slide 5, if we could, which shows the number of credit unions failures that incurred a loss to the Share Insurance Fund. In 2022, you said that 4 credit unions failed in the first 3 quarters of the year, causing $7 million in losses, and fraud was a contributing factor, I think you said, in 3 of those cases. As examiners return on site, they have found an increase in record-keeping deficiencies, problems with internal controls, and instances of fraud. Do we expect fraud to be a primary factor in future credit union failures and Share Insurance Fund losses?
So I would answer it this way, that fraud has consistently been a contributing factor in most of the failures that have incurred losses to the fund. In that period that's shown on the chart, just in terms of the number of institutions incurring a failure, I believe typically roughly 2/3 to 3/4 in any particular year are going to be have some element of fraud as a contributing factor.
Yeah, and fraud would be more of a contributing factor in smaller credit unions, possibly because they don't have as tight internal controls as larger.
Well, certainly from what we've seen over the past couple of years, that instances of failures have been at relatively smaller credit unions, and fraud has been a contributing factor in most of them.
Thank
Yes.
you, Eugene. Your response illustrates why the NCUA must continue to conduct on-site examinations, at least in some form. Even though we learned during the pandemic that many more of our examination procedures can be completed off-site, it's important for examiners to go into credit unions to examine documents, ask questions, meet with staff, and review internal controls. That will require at least some increase in our travel costs, especially compared to the last 2 years when the pandemic curtailed on-site examinations. So as the NCUA considers the 2023-2024 budget, we must ensure that our efforts are penny wise. Our efforts to be penny wise in the examinations process doesn't ultimately result in being pound foolish for the Share Insurance Fund stability and strength. As noted in your presentation, Eugene, the Share Insurance Fund also continues to see unrealized losses because of rising interest rates that are lowering the value of treasury bonds held on these books. These unrealized losses, as you noted, do not impact the equity ratio, just as unrealized gains do not impact the equity ratio. We, however, should consider these unrealized losses when structuring the Share Insurance Fund's investment ladder, especially if we determine that we need more liquidity in the near term, given current conditions, and don't want to sell investments at a loss. Earlier this year, the NCUA adjusted, and we talked about this at a prior board meeting, its investment strategy, moving from a 7-year ladder over to a 10-year ladder in response to the changing interest rate environment. On slide 6 of your presentation, you summarize the Share Insurance Fund's investment portfolio. While we are now working to build out the 10-year ladder, we must also ensure that, as I said earlier, that we've got sufficient liquidity in the short term. Such overnight reserves would ensure that the fund is prepared to handle an emergency, any emergency that may arise in the current uncertain economic environment. So if we decided to increase the Share Insurance Fund's immediately available liquidity by investing more in overnights, how might that affect the portfolio's average yield?
Okay. So I think I'll address that from sort of two perspectives. The weighted average yield, as you can see on slide number 6, for the third quarter was 1.42%. And as I mentioned, recent maturities had yields ranging from about 0.12% to 2.12%. The overnights have been earning about 350 to 370 basis points. So funds held in overnights right now are actually helping to increase the weighted average yield at this time, just because they're so much higher than the weighted average yield as reported at the end of the previous quarter. However, the overnights will yield less than long-term securities.
Sure.
So there is, and although that spread right now is relatively small, but holding more in overnights does come with some opportunity cost.
Sure. No, I appreciate that, and it's a balancing act that we have to perform here. With inflationary pressures and increasing interest rates, a credit union's ability to manage interest rate risk and liquidity risk will remain a crucial factor in its performance for the remainder of 2023. Simultaneously, the board will continue to monitor trends and developments in the economy, financial markets, and credit unions. If any issues arise, the board will also be ready to take action to protect credit union members and the Share Insurance Fund. Lastly, if credit unions encounter liquidity issues, it would be important for the NCUA board to have the strongest possible central liquidity facility. The CLF is a critical source of emergency liquidity for the credit union system and the Share Insurance Fund. As such, during 2 hearings this week, I asked Congress to make the Central Liquidity Facility's agent membership authority permanent. 3 out of 4 credit unions currently have access to the Central Liquidity Facility through the agent membership of their corporate credit union. Unfortunately, such access will cease at the year end unless Congress acts to extend the agent member provisions. Given the stress that we are already seeing in financial institutions, the credit union system, financial markets, and the economy, now is the time to ensure that the system has the strongest possible liquidity shock absorber. I know that we as a board stand united in that opinion. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Chairman Harper. Thank you to Eugene. So credit unions obviously have a vested interest in the health of the Share Insurance Fund. It's their money. Under the Federal Credit Union Act, credit unions are legally required to update the bulk of the fund's equity contribution, 1% of the credit union's insured shares. Their capital contributions are the basis of the fund's soundness. Although managed by NCUA, the Share Insurance Fund is cooperative in nature, much like the credit union movement itself. Deposit insurance is about trust. The only way to build trust is through transparency. It's kind of what we're doing today. These quarterly updates remind us of our responsibility for transparency to the owners of the Share Insurance Fund. So right now, a lot of economic forecasts say we may have a downturn on the horizon. I want to remind everybody that this country and our credit unions have been through recessions in the past, some pretty bad ones. Downturns are normal, and so is preparing for downturns. So an increase in the unrealized loss is not a surprise. The same thing is happening to credit union balance sheets. Holding investments to maturity ensures the fund ensures the returns to the fund. It also means that losses remain unrealized and do not impact the fund's equity ratio. That's good news. But that requires careful planning of the fund's liquidity needs. We must be careful to ensure liquidity levels are sufficient to cover sudden changes or to avoid minimizing selling investments at a loss. We can only hold to maturity if you hold it to maturity. Sometimes you need the money and you have to sell the loss. So on a related note, I want to point out that both credit unions and the Share Insurance Fund use the Central Liquidity Facility as a source of emergency liquidity. In fact, the CLF is the only practical source of emergency liquidity for over 3,600 credit unions with less than 250 million assets. It's the little ones. The current agent program, which was included in the CARES Act in 2020, allows the corporates to put up the capital for a subset of their credit union members. The agent provision is set to expire at the end of the year unless it's made permanent or extended by Congress. And I yield to no one in wanting to put all COVID things behind us forever. But there was a part of the CARES Act that does have a purpose that I don't think extends the COVID nightmare any further.
And if I could just for a second, and we've had asked for this authority well before
Yes,
the CARES
right.
Act, so it's something that's been a long-term priority.
Massive legislation in Congress, it won't shock you, often has unrelated provisions in it. Dodd-Frank in response to a financial crisis, the whole thing with conflict minerals, blood diamonds, things get thrown in that are not necessarily part of it. It is what it is. Anyway, so if the provision is not extended or made permanent, we expect a reduction of about $10 billion in reserve liquidity for the credit union system, including the Share Insurance Fund, due to the corporates withdrawing of their funds. That's $10 billion buffer between credit unions and American taxpayer. NCUA will continue to communicate to Congress. Mr. Chairman, that concludes my remarks. I have a couple questions for Eugene, though. Eugene, you indicated the Share Insurance Fund has roughly $362 million in overnights with the Fed. If we believe $362 million is not sufficient, how will the investment committee determine the appropriate level of liquidity?
Sure. So let me also provide one update. The $362 million was as of September 30th, the end of the third quarter. As of yesterday, overnights had actually increased to $1.7 billion that we were holding. The result of that increase is the result of the capitalization deposit adjustments that we collected last month that we've been holding into the overnights, as well as pausing on long-term reinvestments of maturities. So that's why there's been an increase. And we've done that while the investment committee discusses what the appropriate sort of revised target for the overnights should be. Some of the factors that go into those discussions when the investment committee considers what the target should be would be first, if there's any known or foreseeable liquidity event that can be on the horizon that we would want to make a factor or allowance for. Then assessing also the various macroeconomic trends in the economy to provide some insight on the future direction and how that may impact credit unions and how that could possibly flow through and impact the need for liquidity in the Share Insurance Fund. The timing and the size of upcoming maturities. So the portfolio is generally at this point structured to have about $650 to $700 million coming due quarterly. So we take sort of that projection into account. How soon will we need the money versus how quickly are the maturities coming? And finally, the overall position of the portfolio, which has been discussed, which is the extent to which there are unrealized gains or losses. Certainly being in a loss position as we are now argues for having more liquidity available such that, as you say, we only realize the loss if we have to sell it for the loss.
All right. Just got one more, just to follow up. All right, so what's the strategy? Let's say we have a major event, right? We don't want one, but that's how insurers are. Sometimes you got to write checks. We have a big event. What's the strategy to make sure we have the cash to do that?
Yeah, so I mean, first we take a look at what is that liquidity flow coming in, like I was mentioning. So the ladder has a continuous sort of cycle of maturities coming forward. And we look at those factors that I also mentioned regarding the overnights to kind of see what can we see potentially coming. And so it kind of taking those into account give us a sense of what we can foresee coming, and then also considering what's happened in the past. So what have been some of the high water benchmark incidents, sort of those really bad events that maybe we don't foresee it coming, but we know those kinds of things do happen. And so factoring that into the calculation. And then the final thing is the fund does have sources of borrowing authority from the Treasury or from the CLF, should those be needed to be accessed.
All right. Again, can we stress test this for a second? That's what the fund's for. I think we forget sometimes that we can actually have normal recessions in this country. The last two were so different. 22 million jobs lost in 1 month in 2020. And then before that was a financial crisis where, people were buying gold bars and burying them in their backyard. The whole world was falling apart, and I hope we never have anything like that again in my life. But we can have normal recessions. After the dot-com bust, early 2000s, the one in the early 90s. They're not fun, but it doesn't feel like the entire world is falling apart, which is what the last two were. All right, but let's say we do have housing prices decline 25%. Let's say it's a real bad one, worse than we expect. How are we looking for that?
So again, I think that between the liquidity that we've positioned for now and the borrowing authority, I think we'd be able to respond to that sort of moderate type of recession. That moderate recession would probably change the current position of relative loss, unrealized loss that we're seeing. Typically in such an event, interest rates would come down, and then we'd start to sort of potentially have it. Usually in a downturn, we're going to have unrealized gains, which is what we saw at the start of the pandemic.
As low earning as we get from treasuries, the upside is they usually rise in value the most.
Right.
When everything falls apart economically. So I got you on that. All right, I'm good. Back to you, Chairman Harber.
Thank you so much, Board Member. Thank you so much, Board Member Hood. You're now recognized.
Great. Thank you, Mr. Chairman. And Eugene, good morning, and thank you, as always, for your oversight of our Share Insurance Fund. And I, too, want to applaud you and OCFO for the hard work you've done and congratulate you on getting a clean audit opinion. I think that's remarkable. Eugene, at a previous board meeting on the status of the Share Insurance Fund, we discussed the outside accounting firm we hired to look at the true-up issue and how this impacts the equity ratio. And this is for the record. At one of the last Share Insurance Board updates, I believe we discussed that the true-up memo by the outside accounting firm states that the timeliness and accuracy of the data is required in the Federal Credit Union Act. So this provision in the law, and I quote, may provide some latitude from a strict interpretation that the equity ratio must be calculated based on the financial statements amounts, particularly given the knowledge of the timing effect on the calculation of the equity ratio. Accordingly, it may be permissible to use the pro forma calculations of the contributed capital amount when calculating the actual equity ratio, end quote. In a previous board meeting, I noted that the letter pointed out the current practice understates the equity ratio by several basis points, and that there were, in fact, several options for correcting this understatement. Can you please provide an update on what are some next steps regarding this?
Sure. So a team from my office and other offices and NCOAs, such as E&I and the Council's office, have been looking at those options that were put forward for ways to alternate ways to possibly consider the equity ratio calculation. The team has been assessing various factors such as the impact to NCOA operations, potential impact to credit union operations, certainly legal and both the regulatory and statutory potential changes. As I've previously updated, we've been on target to, I think, wrap up sort of the assessment of that during the fourth quarter. This is the fourth quarter. I believe we're still on track to wrap up the staff's assessment of those alternatives and then to bring it forward for kind of a discussion so that the board understands kind of the, kind of deeper understanding of kind of the pros and cons that those various alternatives would bring with them.
Very well, I look forward to that, so thank you. I do have a few more questions as well. I know we've talked a bit about fraud and how the failures we've had to date have resulted from fraud. I agree, getting our examiners back on site is important, so like you, Mr. Chairman, I don't wish to be penny rich or pound foolish when it comes to ensuring that our folks are there on site to detect and discover fraud and mitigate it head on. But my question for you, Eugene, if we look at the failures to date, how many of the frauds could be attributable to third-party vendors? Do we have any knowledge or insight about that at all?
As relates to third-party vendors, I do not have any particular data on that. I would note that, as I previously said, the 3 of the 4 were related to fraud, which I don't think has any bearing on third-party vendor. I'm unsure about that 4th incident, though.
Well, I look forward to us just looking into this matter. And in addition, I hope we can do some training sessions and things like that for the industry regarding the small credit unions and what they need to really look into. I know the larger institutions have ample resources, but as we provide cybersecurity training, CECL training, I would certainly like to see us focus on how do we provide ongoing fraud training and mitigation for the smaller institutions. I know we've talked a little bit about the investment portfolio, so I don't want to go any further than what my colleagues on the board have discussed, but I just want to understand, given the high interest rates that we've experienced, is every single security in our portfolio underwater?
That's correct, Board Member Hood. The continued and sizable increases in interest rates mean that the entire portfolio, other than the overnights, is underwater at this time.
Oh, well, very well. Not much I can do about that. We talked a little bit about how if we needed liquidity as an agency, that we do have borrowing authority through either the CLF or Treasury. Has there ever been a triggering event that has resulted in us having to use that authority? I know we have it, but has there ever been an event where we have used it?
Oh, yes. Certainly the 2008, 2009 timeframe, we did have to rely on outside borrowing. That was, of course, part of the creation of the temporary corporate credit union stabilization fund and I believe it's $6 billion that was borrowed at that time from the Treasury. So yes, when times have gotten particularly dire, we have had to rely on that borrowing.
Very well. At least it's there for a reason for us to use it. Final question. This is looking at slide 9. And as that's coming up, I see several sizable institutions change in their CAMEL score. And I wanted to ask, and I know this came up during our briefing, I wanted to know, are there any takeaways from this data? As you recall, I mentioned that does this have anything to do with the new S component that we as a board have added to the CAMELs, as it was CAMEL for so many years? I'm just trying to look for some contributing factors.
Sure. So just to answer the last question first, I don't think that the addition of the S component and breaking it out from the L specifically is the contributing factor to this. There have been a few large credit unions that have seen downgrades to their CAMEL's composite ratings, and the reasons are really different based on each institution's circumstances. But a few general observations, I would say generally they can be attributed to a decline in the financial condition given the current economic condition. So this does include elevated interest rate risk, but examiners have also noted increased liquidity and compliance risks at these particular institutions. The downgrade in the CAMEL's rating also reflects a lack of governance or poor management practices at those institutions. So overall, it's not really related to one particular element, nor the S.
Very well, thank you. I have no further questions. Thank you, Eugene, and Mr. Chairman, I yield back my time.
Thank you so much. And if I could just a second, because your borrowing questions are a really important question. It's not like we can go to an ATM at a credit union
Exactly.
and immediately pull out the cash. What are the, what's the time delay when we have to go and do borrowing? Because certainly that can be another way in which to provide that immediate liquidity.
So I'm afraid I can't be terribly specific as to what that would be,
Is it a
but
week? Is it a month? Is it?
An hour?
yeah, well, yeah, probably not the hour or even the day, but I would imagine, and again, it's also going to be in conversation because we're borrowing with, dealing with Treasury, is to considerations on their end. But we have the agreement with them so that we're able to do it, and I would sort of hazard to guess that it would be, probably weeks, but not an extended months or so forth. And we also did, in recent discussions with them, make clear that we don't have to liquidate the entirety of the share insurance fund prior to going.
Right.
That we are able to go. We have the statutory ability behind us to go sort of as we see need.
Yeah, no. And one thing to answer your question is that I know that OIG did a report on third-party vendors, and they found that, if I'm remembering the numbers correctly, that over a period of about a decade, losses at QSOs contributed to 11 failures that cost $300 million to the share insurance fund overall.
Okay.
So,
Thank you.
You're welcome. Thank you, Eugene. That is the end of our meeting today. Before we adjourn, I'd like to extend my heartfelt wishes for a happy Thanksgiving holiday to each and every one of you here, as well as to all of you watching online. I'm grateful for many things, including my fellow board members and the entire NCUA team. May you and your families enjoy the time together this coming week. There being no further business, we are hereby adjourned.